Good afternoon. We'd like to welcome our subscribers today. You're the reason we're here, and we're so honored and thrilled and delighted to have Sir Alasdair Macleod. He's really does all the research and content for Gold Money, and is also working in the New York-based Shift Gold company. Is that correct?
Yep, it's part of the group.
Tell us. We're all interested. We think Peter Schiff's sort of our hero because he's the only one that wins these arguments against these crypto people on Kiko and Stansberry. So tell us about Shift Gold, please.
Well, Shift Gold is I mean, we bought Shift Gold from Peter. Peter's still involved with it. I think he's chairman. So it's a sort of standalone operation within the Gold Money group. And I think we've had it for, I mean, time flies, 4 or 5 years, something like that, maybe longer. But it's basically Gold Money stores bullion, if you like, gold and silver, platinum group metals in LBMA registered, fully insured vaults around the world. Whereas Shift Gold is far more a sort of American retail dealer in coins, small bars, to be delivered, if you like, to whoever wants to buy them or deal with them. So that's it. It's the two ends, if you like. I think we're almost, it would be slightly wrong to say wholesale and retail, but you know, if you think of the division in that sort of sense, it's not too far from the truth.
Gotcha. Yeah, I'd see the Shift Gold's almost like a direct to consumer, DTC, I think they call that.
Perhaps. That's pretty good. Yeah, I think that's fair. Yeah.
Okay. Well, thanks for that background. For those who are not familiar with the Alasdair's work, I urge you to read his weekly column on Gold Money because you get sort of a background in banking side as well as the history of money, and in the way he weaves systemic risk in there, especially with current geopolitical events. I mean, Lennon had that brilliant quote, Alasdair, of, you know, that there are decades when nothing happens, and then there are weeks when decades happen. And I think you're the only one I know of from a journalistic side that have kept up with that extremely well. And my hat's off to you. I would take it off, but I don't want people to see my bald head right now. So I thought what we do for the subscribers today is kind of go through, starting in 1204, briefly, what happens when we depart from gold and silver and some of the shenanigans we've seen in at least 4 or 5 countries. And then we're going to let Alasdair sort of catch us up with perhaps maybe even things he's seen going on with BRICS and China. I know I watched you once on Adam Taggart's show, and you gave him sort of the rundown on how China was starting to kind of position themselves from exiting the toxic orbit of the dollar. So we're going to end with a lot less of me and a lot more of him. So this is just a picture of Constantinople, and let's learn what happened with what they call the sack of Constantinople and the way the war bonds were used. You know, it takes money to go to war. The Doge was sort of like the politician. They were going to raid Jerusalem, but they pivoted to the wealthy state of the Byzantine Empire, and they got a lot of silver and gold, and the people financed the war. Now, Alasdair, can you tell us about the rente in France? Is it a similar version?
Well, I mean, all these, there've been so many paper currencies over the millennia. I mean, even starting with China. I mean, I think the first Chinese paper currency was sometime in the centuries before Christ. But when Marco Polo went to China in around about 1230, 1240, round about then, Kublai Khan, who was the son of Genghis Khan, basically ran things at that time, and he, by decree, forced everybody to submit gold, silver, precious stones, and so on and so forth, which could be used as money, in return for which he gave them paper currency printed on mulberry leaves. And You know? So, I mean, we still have the gold and silver, but where the hell are the mulberry leaves? I mean, they go. And this is actually the story of all these things, whether it's the sort of French war loan, which you've got up here. I mean, I think that perhaps the better story coming out of France really was in 1720, because in just 2 years before then, a Scotsman called John Law, who was a very, very able gambler, came up with an economic theory which could have been actually written by John Maynard Keynes. I mean, you could put a cigarette paper between Law's theory and Keynes' theory. It basically was produce credit out of thin air, and you can kickstart the economy, and there are all sorts of benefits, etc., etc., etc. But it's something which we do know that credit is required for an economy to expand. That's fine. We don't argue with that at all.
Right.
But where we argue is it's not the role of government to provide it. It should be demanded by people thinking, I've got an idea, I need to raise some money in order to do this profitable idea, and I can go and convince my banker, hopefully, to do it, if I put together the right plan, so on and so forth. That is, if you like, the right way to expand credit. But, under demand by the economy, not by diktat by the government. When the government tries to do it, which is what John Law did, which Keynes broke Say's law in order to come up with macroeconomic theory, because all that comes from denying Say's law. But going back to John Law and the Mississippi bubble, he managed to persuade the Prince Regent, because the Sun King had recently died, and the young Louis was not of age, so there had to be a Prince Regent, and that was the Duke of Orleans. Law managed to persuade the Duke of Orleans to give him a banking license. So he set up the Banque Générale, not to be confused with the Banque Générale that we have today. Right. And he started issuing partly paid stock in this wonderful new venture. And, when you get a partly paid stock, like 10% down, and don't worry about the other 90%, that'll be paid in, say, 6 months' time or 9 months' time or whatever. You can ramp up the price, which is basically what he did. He did a very good stockbroking job. Yes. I mean, look, I've been in corporate finance. I know how to do this. He was brilliant at it. He created a shortage in the market, so his stock shot up, I mean, many, many times. And the origin of the term millionaire actually comes from this period. People were making millions. You had the sort of disruption of society, like the nobility's coachmen were making more money than their masters, and consequently, it was them who were driving around with coach and horses and all the rest of it. It was a bubble to end all bubbles. Well, not quite. There've been a few since then, but the point is that having done that, having ramped up his share price in his Banque Générale, he then got it changed into a royal bank. In other words, acting on behalf of the Prince Regent and the Crown directly. So it became Banque Royale. And with all the money out of thin air that he was making out of credit, basically issuing these notes, livre notes for specie, then he made so much money doing this, printing money. He also got the license from the Prince Regent effectively to issue currency. So he's not only running the Royal Bank, but he also had the currency issuing thing, just like a modern central bank. And from there, he bought into a number of, if you like, import-export licenses. So he ended up controlling the total import and export trade out of France. And this was, one of the major parts of this was the Mississippi element, which is why the whole thing became named the Mississippi Venture. But he also had interests in this under this umbrella elsewhere. Anyway, this speculative bubble popped in around about February 1720, because he was merging these Mississippi interests, the Oriental bit, as it were, with the Banque Royale, and that happened in February. The royal family were paid out by some extraordinary figure. I can't remember quite what it is, but anyway, they cashed out to a degree, and that marked the top of the market. The bubble started imploding from there. And this ended up really bankrupting everybody in France. John Law had to get the hell out of it. He ended up actually being buried in Venice, apropos what you were talking about, Venice.
Yes,
yeah, I mean, the other interesting story in all this was the role of Richard Cantillon, who was an Irish-French banker. He was an Irishman who was working with the British in the 7 Years' War, acting as, if you like, sort of handling, the sort of logistics and all the rest of it, with the Master of Stair. The Master of Stair became immensely wealthy. Richard Cantillon did pretty well out of it. He joined his cousin, another Richard Cantillon, who's known as Le Chevalier Cantillon, in Paris, who was already acting as a banker. And from there, he started lending money, lending currency to people who wanted to speculate in John Law's Mississippi bubble.
right.
But he was a pretty cute guy. He didn't believe in this bubble at all. I mean, he was a bit old-fashioned, if you like. So he sold all the stock that was held as collateral against these loans the moment he got the stock. So, this was a sharp practice to you and me. But anyway, that's what he did. And it was the right thing to do, because obviously the whole thing collapsed, et cetera, et cetera. There was, to be fair to John Law, the Mississippi venture did survive this crisis. And in fact, we had to boot out the French out of India some 40 years later under Clive of India. So there was the company did continue. But where Cantillon was extremely clever was he decided, he had to take a decision. Do I actually short the stock, or do I short the currency? He decided to short the currency. Now, the thing that's interesting is that from February to September, he was shorting it very heavily on the London and Amsterdam exchanges, which were the two foreign exchanges at the time. And the French livre, John Law's livre, went from not a lot down to zero. There was no quote for it at all on either exchange by October 1720. So he absolutely cleaned up, made a fortune, wrote his essay on economics, which I think he published. Well, he published it in French, but also, he was living in London at that time. There were various lawsuits against him in London by people who had bought stock through him and found that he'd already sold the stock. So, but none of them won that lawsuit. And it was actually on a technicality, because the stock wasn't identified by number. So therefore, it was a general stock. Therefore, it had the same legal position as pound notes, dollar notes, whatever. In other words, someone can steal money off you, but if they go and spend it in a shop without the shopkeeper being involved in the theft, then you've lost possession of that currency. And that's basically what got him off the hook in the London markets. And he was able to sue everybody who owed him money, having lent him these francs, sue them for all that money. And I mean, he was obviously a very unpopular man by the time he'd gone through all this. But my goodness, did he do well? So that was a fascinating story. And as to the point, the whole thing about that French experience is that what we have today is a similar situation, not confined to one country, but for the whole world. This Keynesian belief that the expansion of credit, or control of credit can actually be managed by the government in order to achieve whatever objective the government wants to achieve, actually leads to bubbles and disaster. And what do we have now? We have the Mississippi bubble, but everywhere, absolutely everywhere. I mean, when you get interest rates forced down to negative levels. I mean, it didn't quite get there in America, but my goodness, there were lots of people saying the Fed should go into negative interest rate territory. They did and they're still there, incidentally, in Japan. They did also in Europe. There are, therefore, as this bubble implodes, there are very, very substantial consequences yet to be faced, just the same as between February 1720 and September, October 1720. I mean, it didn't just collapse in one go. I mean, it was, a continuing collapse to the point of currency valuelessness. And the underlying point about credit is that you need to have credit attached to something, because the value of credit is only what you believe in it. It's no more than that. It was the expression, I think, which came out of a Congress on something completely different, is the full faith and credit in the United States, the full faith and credit in the government, the full faith and credit in the currency. But that's only faith and credit. It's not actually anchored to anything tangible. And this is the point which I think we're now about to challenge.
Fascinating. And before I let you loose on the next chapter, I want to just get a little more historical context. I think you drove the point home very well. I do want to interject. You had spoken about, in fairness to John Law, not only was his acumen in gambling was way above average, but he was also a good womanizer, and he was also known as a good at pistol dueling. I believe he was pretty good at shooting guns. So I think he had the trifecta skill set there. And forgive me for those who are listening that thought the womanizing comment maybe not be woke. We're just having fun on this podcast today with Alasdair. Now, Philip III sort of crashed the situation with the euros. I just wanted people to see this history real quickly. What happened there was similar to Rome, where you have a denarii at 95% purity in silver. And then by the time Rome collapsed, I believe it was down to 3 to 4 to 5%. They introduced the base metals of copper. It's the same as whether you're debasing the coin or inflating the money supply, has the same net effect. Now we're going to Alasdair's area, where 40 businessmen loan money to William III to finance a war in France, establishing the Bank of England. But these guys were smart. They had leverage on the king, and they said, guess what, William III, you have to let us have the monopoly on issuing the currency. And now I want Alasdair to say, what happens when we see this merging of banking cozying up to government elites so they can, let's say, go to war?
Well, what can one say? I mean, the thing about the Bank of England is that essentially it was appointed as the government's bank. That was the whole thing. So when it came to the government raising money, the Bank of England didn't actually have a monopoly on that from the outset. It was something they earned, I think, really in the wake, if you like, of the collapse of the French Sword Company, which was the British bubble, if you like, at the same time as 1720, and that the Bank of England stood aside from that, so it wasn't affected. Things evolve. I think this is the point, John, behind this. I mean, you do need credit even if you're a government, and if that is handled against a background of the currency being exchangeable for specie, whether it's gold or silver, and so we were on a silver standard at that time.
That's right.
Then that's fine. I mean, that anchors the value of the credit. But there were times when this came slightly wrong. and I'd like to go back just a little bit to the time, I think about 1680, 16, around about then, we had a great recoinage. And the point about the recoinage was that an awful lot of the silver coins in particular, gold coins, I think hardly circulated, but the silver coins which were in circulation had become clipped. So this was, instead of debasement. And indeed, at the time of Elizabeth I, one of her chief ministers was Thomas Gresham. And it was him who was associated with what subsequently became to be named as Gresham's Law, and that is the bad money drives out the good. What he was referring to there was, when you get a handful of coins in your change, some of them are clipped and some of them are relatively whole. What you do is you hang on to the ones which are good and you spend the ones which are being clipped. And in earlier times, debased as well. There was a fascinating story. I'm going to go right back since you're so interested in the history of this. And if we go back to the time, I think it was Henry II, we're looking at about 1232, I think it was, something like that. My memory might be slightly faulty there. But in those days, what happened was that coinage was produced under license, in effect, by people called moneyers. And there were moneyers all around the country. I mean, bear in mind that you couldn't really travel much around the country. So things had to be devolved, if you like, in order for the coin of the realm to be in circulation throughout the country. And what these moneyers began to do was they began to debase the coinage. And obviously, this meant that there was more coinage in circulation than there should have been. Let's put it that way. Now, unfortunately, this coincided with a harvest failure. And the result was that food prices rocketed. You had, insurrection, you had starvation. I mean, a real crisis. So Henry II called the moneyers together to a meeting in Winchester, which in those days was the capital of this country. And these moneyers were tried. Their coins were assessed for their content and all the rest of it. And those that were found guilty had their right hands chopped off. And in the words of the Anglo-Saxon Chronicle, and their testicles removed from beneath. So, this, if you like, was the first recorded event in this country of currency debasement by debasing the coinage. In this country, we go back a long way. This again, I mean, you can go back to Roman times. I mean, the Emperor Nero, in the sort of, I think around about 40 AD, 50 AD, I think it was around about that time, he started debasing the denarii in order to pay the troops. Because if you didn't pay the troops, they might actually bump you off. So, there's a bit of a requirement, let us say, to keep them happy. And it was a debasement which continued for some considerable time. And when it got to the time of Diocletian, prices were rising so fast in Rome that what Diocletian did was he produced an edict. And we're talking now about 230, 240 AD, something like that. So this was a fairly long decline, if you like, in the precious metal content of the silver denarii. Anyway, he had this edict of maximum prices. And the thing is, it was interesting for us today for two reasons. First of all, the consequences in Rome, it basically meant, if you broke the edict, then you could be executed as let's say, a butcher or a shoemaker or, tradesman, whatever. So what happened basically was everybody shut up shop. Right. And so if you lived in Rome, you were going to starve because you couldn't buy meat, you couldn't do this, you couldn't do that. Looking at the edict, which you can see again today, the other thing that's fascinating is that if you look at the prices, the maximum prices that Diocletian put into his tablet of stone, you can see actually that similar goods today have similar prices in gold. And so this confirms that the purchasing power of gold, which is basically the people's money enshrined in Roman law, has just moved sideways the whole way. It has been constant. It is quite remarkable. And this is something, I think, which really means that gold will always be money and everything else is credit. So the only way you can secure the purchasing power of credit is attach it to that locomotive of gold, which will just take prices along, just gently sideways,
Right.
decade after decade, century after century, millennium after millennium. And I'm afraid this is a lesson that we're about to learn, because the idea that modern currencies somehow have superseded gold, and gold is a pet rock, or the gold standard is a barbaric relic, or whatever it might be, is complete nonsense. It really is. It flies in the face of history, and importantly, John, it flies in the face of law. And I'd just like to say something about this, because the Romans first started laying down laws in the 12 tables of 450 BC, or BCE as they say now. Anyway, this was an awful long time ago. And over about 1,000 years from then, you had jurors who then took the interpretation of the 12 tables and developed it into juristic, if you like, readings and juristic commentaries and so on and so forth. And all this was combined into Justinian's Pandects, which were dated around about 540 AD. So over 1,000 years from the 12 tables. And it was in those Pandects that the role of money in the form of coin, which is deposited with a banker or another party, remains the property of the individual depositing it. On the other hand, if money or credit is given to the bank for the bank to do what it wants, then the relationship is one of the bank owing the equivalent back to the depositor, if you like, or the person who has taken out the credit. So this is actually set the whole thing in law. Now, the importance of this is that Justinian's Pandects, confirmed by the Basilica, which was around about 900 AD, which translated it all into Greek for the Eastern Roman Empire, put the two together. And what you have is you have the basis of law with regards to money, the status of gold and silver as money and nothing else, right, in all the European countries, really from the Atlantic seaboard, Portugal, all the way to the Urals. Now, just a slight wrinkle on this was that by the time Justinian's Pandects were released, the Romans had left Britain, and we were still taking our common law from the rulings of a juror called Gaius, who was around about, I think, 230 AD, something like that. But that was regularized when the courts of Chancery and a common law were merged. Now, this is very important because it means that credit is an asset. This is what allows you to take government stock and say, I have bought some government stock. The government owes me money. I'm a creditor of the government, but this is an asset in my portfolio. Without that ruling, you could not value it. And this is the most important thing. So, the result is that Europe, from us to Russia to everywhere, colonized the rest of the world, with the exception of China, where they'd also come to the same conclusion in the wake of Confucius, if you like. The whole world has adopted in its common law, if I can call it that, the fact that money is gold, silver, copper as well, and nothing else. The rest is credit. And this is vital. And people just don't understand this point. but they are going to understand this, I think, relatively soon. You mentioned earlier BRICS and so on and so forth. I think that's a story which we need to follow up on when we get to it.
Okay, we'll get to it real shortly because I wanted to reference that I think we're there now because as of August 22 through 24 in Johannesburg, South Africa, Brazil, Russia, India, China, Saudi Arabia, and it looks like they've signed up most of Africa and Latin America too, one by one. But when Nixon took us off the convertibility in the 70s, Kissinger did have the savvy to make a deal with the Saudis it was sort of like a prison yard deal. I'll give you protection in exchange for letting us settle our oil transactions, right, in the US dollar. So it was telling that Saudi left that US arrangement and is now on the side of BRICS. I just wanted our viewers to see that, and this chart is courtesy of Lynette Zhang of ITM Trading, that look what happens after we depart the convertibility of gold. And we've had 57 undeclared wars since World War II. And now, Alasdair, I've heard you on other broadcasts really talk about how other countries, and let's just say BRICS or China or Russia, had been watching the toxic orbit of the US dollar based on, let's just say, our $32 trillion debt and the things that they had been doing systematically. And you can talk about Sergei Glasiev and his gram of gold for a barrel of oil deal, or whatever you want to talk about in terms of what you predict may happen with BRICS emerging as a challenge to US dollar hegemony, please.
Yeah, I'm not going to go, I don't think I'll, sort of go beyond just stating that it should be obvious to everybody that China and Russia basically have taken control, commercial control, if you like, of Asia through the Shanghai Cooperation Organization. And that has been extended to BRICS, BRICS being Brazil, incorporating Brazil, India, and South Africa, which joined later. And that is now being expanded to 11 countries. And there are various other countries likely to join as well. Your mention of Saudi Arabia is very much apposite because Saudi Arabia has basically, I think it's probably too much to say it's turned its back on the West in favor of China, Russia, SCO. But if you look at where they're positioned geographically, it's quite clear that their future has got to lie with the Asian hegemons. So we shouldn't be surprised that Mohammed bin Salman decided to go in that direction. And indeed, I think that a lot of the reason why he effectively did a coup d'etat, again, which is how he came in, was he recognized this very fact. And of course, Saudi Arabia was basically run by our intelligence services, if you like. So he had to effectively boot them out. So this was a major change. The other thing which you must bear in mind from the Saudi point of view is that we're all sort of turning against fossil fuels in the West, and we're so much so that we're saying that we're going to cut out sort of diesel engines and petrol engines. No more are going to be manufactured from 2030 or 2035. I mean, for goodness sake, that's only 7 years away.
Right.
So, we've effectively told the Saudis, look, mate, we don't want you anymore, sort of thing, or we won't want you in 7 years' time. So what are they supposed to do? Love us?
And be careful what you wish for, too. If you're
absolutely.
Right.
So their future is very, very definitely that way. Now, the Saudis are not fools, and nor the Russians. What they have done is they have got together, along with Iran, of course, everybody's enemy in the West, in order to effectively monopolize the production of carbon fuels. And it's not a total monopoly, but we've now got OPEC and we've now got OPEC Plus. Now, OPEC Plus basically is the addition of Russia in that. And so you can see that they can actually do quite a lot of control over prices. And we're seeing this at the moment with diesel and heating oil. Heating oil and diesel are very similar. These are distillates that come out of the oil cracking process, as it were, just like petroleum, or in America it's you call it gas. What's happening there is that earlier this year, OPEC Plus cut their output by 2 million barrels a day. Then more recently, Russia agreed with Saudi Arabia, between them a cut of a further 1.3 million barrels a day. And guess what's happening to the oil price? I mean, we've seen it's now shooting up and testing the 90 level.
Yeah.
Yeah. But when it comes to diesel, now this is terribly important. When it comes to diesel is over 95% of everyone's logistics transportation. I mean, in this country, it used to be 98. I'm saying 95, probably because it's still 98. But you know what? I see a few Amazon vans running around on electricity, but I mean,
it's for branding. It doesn't mean.
And in even trains, electric trains. I mean, how they're driven? They're driven by gas-powered electricity stations and so on and so forth. We can't get off this, but this is terribly important. The other point about diesel is because it is very, very close to heating oil. Heating oil, we've got a winter coming up, and what's going to happen to heating oil demand? With the Russians, incidentally, closing down about a quarter of their exports of diesel and heating oil because they want to maintain the refinery, do some remedial work or essential maintenance work. And the other reason, apparently, is they want to reserve some diesel for their domestic market. So what's going to happen here? I mean, we're going to have a shortage of diesel and heating oil, and we've got the winter coming on. Now, this is actually a very important point, because you've got to not only look at the effect on us. I mean, the effect basically will be to push up energy prices. We will also see other prices rise. I mean, the export of grains from Black Sea ports has been effectively stopped now, or very, very much restricted. That's going to have an impact on food prices. I mean, this is not something that you want to go into a winter with. So we're going to see rising inflation, at the price level. And what does that mean for our interest rates? They will rise too. And not only that, but anybody who's actually taken a minute to look at money supply sees money supply contracting. Why? Because the banks are frightened of extending loans to businesses and extending loans to anyone who wants to speculate in the capital markets. So, this is, we've got a good old-fashioned credit crunch developing right before us now. Now, what does a credit crunch do? It drives up interest rates. It's as simple as that. So anyone who hopes that interest rates are going to fall, or at least they're not going to rise much more before they fall, and you're going to get lower interest rates in the tail end of 2024 and into 2025, common forecast expectation in the market, it is wrong, John. It is completely incorrect. Okay, let's just pivot for a moment in another direction. The Russians have got a problem. You think we've got a problem? They've got a worse problem, because coming up to this winter, what's likely to happen is that the ruble has been falling, and it's likely to continue to fall. The way I would put it, in terms of the land of fiat currencies, the dollar is king, but the ruble is like a serf. I mean, it really is. It's right down at the bottom. Well, I mean, there are other worse currencies, but it is quite clear that in terms of that full faith and credit, there's no way the ruble can compete with the dollar in the fiat currency world. Now, this is terribly important, because if you look at the price of energy domestically in Russia, because the ruble is collapsing, the price is shooting up far faster than it is in the West. And the way I put it in an essay, which I'm writing about this, and it'll be released on the Shift Gold website tomorrow and on the Gold Money website following Monday, I think, is, I mean, the way I'm putting this is that if they if they're shivering in Germany, they're freezing in Siberia. I mean, this is desperately important. So I think it becomes a matter of highest priority for the Russians to secure the value of the ruble against real money. In other words, return to a gold standard. Now, coming back to BRICS, I think the plan was to do this in two stages. The first thing was Glaziev was appointed to look at moving towards a commodity-based currency. And it was quite clear from his few utterances, and particularly an article he wrote for a business paper in Moscow called Vedomosti on the 27th of December, I think it was. He was recommending very, very strongly that Russia should go back onto a gold standard. Now, he was not saying BRICS are going onto a gold standard, but it was quite clear the implication was that that was the way he was thinking. And indeed, my own research is looking at the way in which commodity prices move, both against fiat currencies and gold, show that gold actually is the perfect representation of a portfolio of commodities, raw commodities. In other words, they move more or less in tandem. The volatility is so much less than it is with any paper currency. So gold is the right thing to represent commodity prices. Now, he started off with the mission, if you like, of coming up with this currency, this new currency, trade settlement currency to replace the dollar for the Eurasian Economic Union. And it's quite clear, even from the outset, this was meant to be expanded and to be available to anyone within, let's say, the China-Russian axis who wanted to join in with it. That was stated at the outset. And I think that we got confirmation of this when RT News confirmed that this was going to be on the agenda at the BRICS summit in August, which has just passed. And also you had the Russian ambassador in Kenya saying the same thing. This was clearly going to be on the agenda, but India and China backed off. Now, I can tell you, we've got to look at it from their point of view. The first thing is that China spent a lot of time trying to get the yuan into the SDR basket. If they started settling things in gold, I mean, maybe not directly in their own currency, but there would be a big question mark over that continuing position, if you like, within the SDR. And furthermore, the potential upset to Western currencies of a new gold currency was an area of risk which I think the Chinese felt uncomfortable with. Let's put it that way. And the other thing is that, well, Russia, I mean, Putin is he's not a shrinking violet. I mean, he's prepared to take action. The Chinese tend to take a more evolutionary approach. They let us make the mistakes. They don't sort of, wade in and start, taking the initiative and all the rest of it. No, we make the mistakes and they just benefit from it. That's their approach. Patience, if you like. India is in an interesting position because it has got enormous ties with the West intellectually. I mean, they're very Keynesian, for example. I mean, the Bank of England has always been responsible for recommending the appointments of the governors of the Reserve Bank of India. They've tried very hard to not upset the Americans, not upset the Western alliance, if you like. So they're almost a sort of a bridge, if you like, between the two. They don't quite know which way to turn. They have joined the Shanghai Cooperation Organization, which clearly indicates that in the longer term, they see their future in that direction. So this is to introduce a new gold-backed trade settlement currency was just too soon for both India and China. Now, where does this leave Russia? Russia has a problem because of the weakness of the ruble. Its plan A, I believe, was to start the ball rolling towards gold and to start undermining the Western currencies by having a trade settlement currency for BRICS. That plan has now been rejected. Plan B is to go ahead with tying the ruble to gold. And I think that that is becoming a matter of extreme urgency because this winter, I think if Putin doesn't do that this winter, I think the consequences are likely to be very, very destabilizing for his government, his own authority, and the legacy that he actually wants to leave. I mean, it's commonly believed, and I've had someone who has actually met him, and the answer is he sees himself as a latter day Peter the Great. That's what he wants to go down in history as. And let's face it, every leader of a country, if they've got time to think, they want to sort of be remembered for the person who really progressed the country into a new plane, secured it, if you like, will be remembered by historians as one of the most important people in the history of the country. That is what Putin wants. And it also, I mean, politics in Russia, I think, can be a lot rougher than it is necessarily with us. I mean, it can be bad enough with us. So, this is something where I think he's got to take the bull by the horns. He will probably find an excuse to do it of some sort, but I'm writing about this, how it can be done. It's actually very easy to do. It's very, very easy to do. There are mistakes to avoid. I write about those. But I would be very, very surprised if we don't see some move in that direction. And remember, the other thing is that perhaps as a fallback to this plan B, Russia is taking over the chairmanship of BRICS on January the 1st. I think you'll see more nations joining the whole thing. But this still leaves Russia with the problem that there is no way the ruble can have any sort of credibility, particularly when Western foreign exchange markets are really driven by all our propaganda about how awful the Russians are and how Putin is going to fall over and da 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 da. We're not going to give them any credibility in our foreign exchange markets. He's got to recognize that. There's no way, if the dollar goes down, the ruble goes down even faster. So the disaster that's visited on us will be also visited in spades on the Russians, unless Putin actually secures the value of ruble credit to gold. And I think that's now his only option.
Now do you see, everyone, why we had Alasdair on? I mean, his crystal ball's a bit better than ours, only because he's very well educated and a great speaker. And we've run out of time today. Oh, a brilliant writer too. So everyone, please sign on to and follow him on Twitter. He's also on King World News and Shift Gold. So Alasdair, looks like we got through about half of the things I wanted to talk about, but I'll see you maybe 3 months. We'll have you back on. And guess what, everyone? We're going to have his colleague, James Turk, on. And when Alasdair talked about the stability of pricing things in gold, Mr. Turk has published some charts showing the stability of pricing oil at 2 grams of gold. And he's going to show his latest chart on that. It's fascinating. These are 2 gentlemen that we're just honored to have on our show. So with that, I say, we're delighted you were here today and so grateful to have you. If you don't mind just staying on a little bit off air, just so I can thank you a little more. And then those watching, we will have a mineral wealth update in about 2 days. We're going to have Electric Royalties on, and they have a basket of 9 metals that are critical for developing batteries for the transition to net zero that Alasdair was just referencing. So with that, I am going to stop recording, and please hang out for a sec, Alasdair. I'm saying your name right, aren't I?
Yeah. Anyway, thank you very much for having me on, John.
Yeah. Hold on. Okay. Goodbye, everyone.